That's the point, the dimension. At a certain point in time or over a certain period of time. But how on earth do such blunders happen to get into the documents of such a level as the IFRS? The input of information is performed in the same way, both into the accounts of income or expenses and the accounts of assets or liabilities. Ultimately, an account can be identified by the instant or duration token. Any quantifiable accounting item bears such token. Most of the unsolved problems of modern accounting are due to the lack of distinction between stocks and flows, and the inability to tackle numbers of different dimensions. Why do we need financial reporting? To see a picture of a business. What is the expression of this picture in financial reporting? Usually we can hear a phrase like financial reporting is information about the financial position of an entity and about something else. This something else can sound like financial results or financial performance or profits and losses and cash flows or even more intricate way. Anyway, everyone agrees on the financial position, but they disagree about what is beyond the financial position. If we summarize all known numerous assertions about that, they can be expressed by the phrase changes in financial position. The concept of changes in financial position has incorporated a big list of various groups of indicators. So, the financial reporting shows the financial position of an entity and changes in it. Well, why not to combine the financial position and changes in it under one concept? It would seem that nothing could be simpler. After all, we are talking just about the same thing again, the financial position. Changes in financial position are just another demonstration of the financial position. Alas, no such luck. This is the very point where an insurmountable obstacle is erected on the way to generalization. It's impossible to remove changes from the objectives of financial reporting. It would create a gaping void. A declaration that the financial reporting describes the financial position of an entity looks obviously inaccurate and defective. It leaves us with just a bare balance sheet, a lifeless backbone of what is actually a living body of financial reporting. Applying at least two concepts when defining the objectives of financial reporting is inevitable. And regardless of various words and phrases used in various formulas, one will still be able to see both of these two concepts, the state and the movement, in every kind of wording. The conceptual framework for financial reporting in paragraph 112 states that general-purpose financial reports provide information about the financial position of a reporting entity, which is information about the entity's economic resources and the claims against the reporting entity. And then, financial reports also provide information about the effects of transactions and other events that change a reporting entity's economic resources and claims. Now, attention. Both types of information provide useful input for decisions relating to providing resources to an entity. Both types. I don't want to decide now which type of information is more important and which is less. I want to focus on the very fact that there are two different types of information. I would like to clarify that we are talking now and will talk not about information in general, but about quantitative information. All the text descriptions in the financial reporting are not of interest to us now. We are interested in information expressed in financial statements in the form of quantitative figures. And those two different types of information that we noted are two fundamentally different types of quantitative figures. The difference between them are what prevent us from merging the financial position and its changes into one concept. The financial statements depict an entity's business using these figures from 2 points of view with regard to its state and its changes. To see the full picture of the business, any one of them is insufficient. Users of accounting information need a stereo image. Only the simultaneous vision of both perspectives is able to provide users with a stereo vision, when the business is brought before them as a special image, not just a flat drawing. The cornerstone of such spatial stereo vision is the very two things that we are enabled to combine into one: financial position and changes in it. Each of them is reflected in accounting and financial reporting by quantitative figures that are fundamentally different in their nature, meaning, and dimensions. These two groups of figures correspond to the statics and dynamics of accounting. The financial position is the accounting statics, while the changes in financial position are the accounting dynamics. The division of accounting figures into static and dynamic ones follows the concepts of stocks and flows, which are widely used in economic theory. Static figures represent the stock, while dynamic figures represent the flow. In general, the stock means a quantity measured at a certain point in time, and the flow means a quantity measured over a certain period of time. To provide a simple illustration of these concepts, they often use an example of a tub which contains water, and the water keeps flowing into it and out of it. The amount of water that the tub holds at a certain point in time is the stock. The amount of water flow into the tub or out of it over a certain period of time is the flow. In order to state that the tub contains, for example, 50 gallons of water, it is necessary to define the point in time when the volume was measured. In order to state that the water inflow into the tub has equaled to, for example, 10 gallons, it is necessary to define the period of time over which it has been measured. That's the point, the dimension. At a certain point in time or over a certain period of time. A remarkable feature of accounting is widely known. It measures everything by money. But few people pay attention to the fact that the accounting figures are not measured just in monetary units. They are measured in monetary units at a date, or in monetary units over a period. It's very imprudent to claim that the only calculation of money value is quite enough to consider an accounting item measured. Temporal identification of accounting figures determines their dimension. They make no sense without this attribute. Their money values convey nothing. The quantitative measurement of a flow makes no sense without specifying the period. And similarly, the quantitative measurement of a stock makes no sense without specifying the date. The developers of the electronic extensible business reporting language, XBRL, have been faced the inevitableness of identification of every reporting item as static or dynamic. According to the rules of the language, the financial reporting figures should be defined by certain attributes. One of the attributes intended for all the figures on the financial reporting is its period type. XBRL distinguishes two period types: instant and duration. According to the rules of XBRL, the stock figures should be assigned the instant period time. The flow figures should be assigned the duration period time. In the IFRS taxonomy illustrated, the period type is set for all indicators mentioned in the document that can be measured in money. However, as a matter of accounting practice, completely different attention is paid to these two parameters of measurement, money and time. Money is clearly visible in the accountant's daily work. Accounting translates the effects caused by economic events into the figures measurable in money. As the accountants make a debit or credit entry into an account, they always input a number in monetary units. Accounting and money are closely related, associated notions. Meanwhile, time is what the accounting is associated with rather seldom. In accounting work, time remains somewhere in the background as dates specified on the bookkeeping fact documents or as standard intervals, month, quarter, year, used for periodic accruals and statement preparation. Time as an intrinsic dimensional parameter of any accounting figure is often simply forgotten. A well-trained accountant can promptly use expressions such as make a balance sheet for 2019, and his or her colleagues won't be going to wince or shake their head as they have heard this, unlike, for example, physicists who would surely do so had they heard their colleague confusing weight with mass. Well, let alone regular accountants. Even the authors of international standards allow themselves to use expressions that are completely illiterate in terms of dimension. For example, look at paragraph 40 of IFRS 5, non-current assets held for sale and discontinued operations. There's a short passage featuring the following expression twice: the statement of financial position for the period. But there are no figures measured over the period in the statement of financial position. Absolutely all figures within this statement are measured at a specific date. It is seemingly obvious. But how on earth do such blunders happen to get into the documents of such a level as the IFRS? Of course, this is not an evidence of IFRS authors' illiteracy. This is just an evidence of their disregard for the time parameter in accounting. After all, this is not the only example. In other standards, the statement of financial position for the period also occurs. And for such missteps, there is a basis fixed in the conceptual framework for financial reporting. As the paragraph 3.4 says, financial statements are prepared for a specified period of time, reporting period. There are no exceptions for some particular statements. But that's not true. The very first statement that we see in financial reporting is not prepared for a specified period of time. All other statements may be, but not the first one. The statement of financial position is prepared for a specific date. Unfortunately, the time parameter of measurement is neglected not only by IFRS, but by the entire accounting world. And for such neglect there are reasons due to the specifics of bookkeeping. Time in bookkeeping is discrete. Moreover, time is split differently as the information enters the bookkeeping system and as it exits it. At the input, the working unit of time is an interval from one economic event to another. At the output, the working unit of time is the reporting period, which normally can be considered as 1 year. Broadly speaking, the bookkeeping procedure can be described as the transformation of information about economic events into accounting figures. To do this, the effects caused by economic events are posted as debit and credit entries into the accounts, which accumulate data on the specific objects of accounting reporting items. Accounting reflects the information about economic events as one-off events. Even when an economic event is of intrinsically continuing nature, for example, the accrual of interest on debt instruments or depreciation of asset, accountants deliberately split it into one-time virtual events, making accruals, for example, on the last day of each month. In some cases, the procedure that simulates a continuing economic event is performed just once a year, for example, impairment of intangible assets, and sometimes just once in a few years, for example, change in fair value of property, plant and equipment expressed in their revaluation. Recognition of an economic event is the smallest indivisible element of bookkeeping process. The sum of money recognized on any account as a result of an economic event is added to the amount accumulated on the account by that time. This can be represented as follows: xi equal xi minus 1 plus delta xi, where xi is value of item x immediately after recording of the event I. Xi minus 1 is value of item x right before the recording of the event I, which equals to the value of this indicator immediately after recording of the preceding event I minus 1. Delta xi is the change of indicator x caused by recording of the event I. From the first glance at this expression, it looks like the relationship of stock and flow. The amounts reflected on the account before and after the economic event, variables xi and xi minus 1 look like stocks. The amount posted into the account as a result of the economic event, variable delta xi, look like flow. The recording of data on any account caused by an economic event always produces a change of the item reflected by the account. That's why any information posted always looks like a flow. In turn, the result of the data recording on any account is an accumulated sum of all preceding recordings. Therefore, any information always looks like stock after the data is posted. It is noteworthy that this is true for any account, regardless of the nature of the values it reflects, whether dynamic or static. The input of information is performed in the same way both into the accounts of income or expenses and the accounts of assets or liabilities. So, while posting the information about economic events, we do not see those stocks and flows which identify the statics and dynamics of accounting. In this context, accumulated sum and changes in it are merely the elements of the information input mechanism, and they are subject to this mechanism. Any information entered looks like a flow, and any information accumulated looks like a stock. There's not much usefulness in formalization of such elements as stocks or flows. They are indifferent to the nature of the information being compiled. For identification of accounting statics and dynamics, we need other stocks and flows, the ones that are formed at the output from the point of view of financial reporting. We can distinguish a stock from a flow only judging from the essence of the item being formed. If the account accumulates data to be presented in the financial statements as of a certain date, This is a stock account, a static account. If the account accumulates data to be presented in the financial statements as the data over a certain period, this is a flow account, a dynamic account. Ultimately, an account can be identified by the instant or duration token. Any quantifiable accounting item bears such token. We can even couch the following postulate. Any of the quantifiable accounting information is either static or dynamic. You say, so what? The accounting world neglects the temporal dimension of accounting data, simply because it is not important. The practice of accounting can do without the awareness of where the statics and where the dynamics are. By no means, the temporal dimension is very important for all aspects of accounting, and the accounting practice cannot do without understanding where the statics and where the dynamics are. Moreover, I can confidently state that most of the unsolved problems of modern accounting are due to the lack of distinction between stocks and flows, and the inability to tackle numbers of different dimensions. What are these problems and how to solve them by distinguishing statics and dynamics, I tell in other videos.